My name is Shane Brett, and I have a really good panel here today. We're going to be looking at hedge funds and how the environment is changing over the last few years and perhaps in the future ahead. So just to introduce the panelists very quickly, we've got Dougal Breach down the end, who's the head of European Prime Brokerage at Credit Suisse. We've Yuri Kroll here beside me, who's Deputy CEO of AIMA and Head of its Governmental and Regulatory Affairs. And finally, in the middle here, we have Andre Stern, who is one of the founding partners of Oxford Asset Management. So certainly in terms of my own business, Global Perspectives, we do a lot of operational implementation and a lot of regulatory compliance. So I think regulation is probably a good place to begin, because it really has probably dominated the hedge fund world over the last few years. Andre, just in the last probably 3 or 4 years since you spoke to a security financing audience, what would you say have been the main regulatory changes that might have affected your business and your relationship with your prime brokers as well?
So, was it really 4 years ago?
Okay. I believe so.
So basically, I mean, there are 3 parts, I suppose. Number one is, the way you have to resource yourself, given the fact there are more regulations. Number 2, I suppose there's the whole question about what sort of liabilities and what it means to the franchise. And then thirdly, does it in any way sort of change the way you trade and operate? And of course, in the case of what we do, we just run one fund. Our business is actually, with respect to, what we do, we have just one fund. So in that sense, it's simple. In terms of the activity and the portfolios and strategies, we do many, many different things. But nonetheless, it's interesting, on the last point, in terms of how we trade and what we do, there's been no change. So it hasn't really affected what we do at all.
Okay, so the regulatory environment hasn't implemented.
No. I wish Dr. Holler would have stayed. I'd like to have given him a beating. But sadly, he's ran off. I did ask him. But but in terms of resourcing, we employ a lot more people just to keep us on top of. We have more lawyers than I care to know. It's distracting. I mean, I don't want to spend time on regulation. And then, of course, one last thing, if I may, it is interesting how some of the stuff we are now asked to do is just absolutely mindless, silly, and serves no purpose at all.
You mean in terms of gathering data or financial reporting?
The reporting is the Form PF, which is a new SEC thing.
Yeah, of course.
It's a pain in the arse. I mean, I don't know who on earth actually. I mean, it's interesting information. I like reading what my competitors do, in the sense that you can access some of the stuff. But I don't know who it's supposed to help. It just isn't clear to me.
And I actually don't find Form PF as bad as Annex 4, as bad as the new AIFMD piece as well, just in terms of the amount of data and quite the inflexibility of the answers. So I think it's probably going to get more extreme when they start submitting them quite soon. Dougal, just in terms of your relationship then with your hedge funds, how have you seen that change over the last few years, or how's your business evolved?
Well, I think the thing with all regulation is it ultimately forces change, and everybody evolves in one form or another. I remember looking at AIFMD a few years ago and thinking, how on earth are we going to get through this? It was probably one of the most impossible pieces of legislation out there. As ever with these regulations, the intentions are very well thought about. I mean, AIFMD really, post-2008, is about making sure you know exactly where assets are held, client assets are held, and who's responsible for doing that. It has lots of knock-on impact from there on in, but that was basically it at its nexus. But I think as we go through this process, we find a way of navigating, and I think the lobbying process has worked quite well on AIFMD and other things as well. But we've had lots of other challenges. So the FTT, again, it does change behaviour. People might, for instance, trade physically. They may just start trading on swap in order to accommodate that in one form or another. So people do change. I think another interesting rule out there was the short sale rule. And, interesting enough, when that first came in, we saw shorts drop off by 10%. But very quickly they recovered, and I think that now those levels are 10% beyond wherever that was. I think the 0.5% threshold has been interesting, though, because, again, I think in terms of overall shorts, we haven't seen as many of those happen. And I think that's simply because people don't want to disclose their positions. I think there's still a slight worry about doing it. You've got to have real conviction if you want to make that work. But again, if you think about what regulation has done, it's actually, with the enforced locate rule and the mandatory buy-ins, it's just made the market a lot more efficient. I think possibly the only issue that's caused our clients maybe is time delay on price discovery. I think that's probably the key thing.
Sure. And just in terms of, I suppose, increasing costs, so how is your business reacting to that? Is that something you're...
So I think it's less about increasing costs, but really understanding how you work with your clients. And if you go back to 2008 or pre-2008, as a prime broker franchise, we'd obviously talk to clients about the holistic relationship with our clients, throughout the firm. At that point, it was much more of a dream. I'd say these days we're absolutely driven by it. Every decision we make is driven by it. And it's about really understanding how you use your scarcest resource, and that's balance sheet. So we have a forensic process now whereby we can recognize how we're using a client's assets, how the client is interacting throughout the firm, and track that back to one number so we can turn around to the firm and say, we're using that balance sheet in the right way, we're getting the right rate of return against that. And by the way, this is a conversation we have very openly with clients. We talk through where we've got the right balance of assets and where we haven't. Pre-2008, all collateral was margined and financed at pretty much the same rates. Since that time, we've now become a lot more distinctive about assets which are very, very liquid, which are very easy to finance and possibly balance sheet mitigants, versus those which are more liquid, and ultimately you need the bank to end up financing them. So I think it's less about passing on costs. I think for clients that have very liquid strategies, the costs have remained pretty much the same. For clients that trade in a more liquid way, then it means that they have to pay up, and that does affect their overall return and how they manage their portfolios going forward.
In fact, I would go further. I mean, it's interesting you say that. I mean, Dougal and I know each other well.
He's a client.
He used to cover me when I was at Morgan Stanley, and then he became a big shot at Credit Suisse, and now he's trying to get more business.
And succeeding, I hope.
I mean, what's interesting is that our experience has been, we have seen no price increases anywhere.
Okay.
In fact, if anything, there's so much competition for our business that people are, they're very reputable firms, blue chip firms, who do things I never ever thought they would offer us, 5 years ago. So, for example, as Dougal knows, because we negotiated with Credit Suisse, how many years? 2 years?
2 or 3 years, yeah. Painful process.
So we did no business until we had the contract sorted, and that's how we operate. There are certain firms who were notorious. In the sense that they say you either accept our contract or you don't do business. Yeah. Everybody is prepared to talk about contracts now and arrangements and counterparty considerations. So I think in our world, and we are in a liquid world, we've not seen any change.
Okay, great. So Yuri, would you agree with some of Andre's? I suppose your broader membership, are they seeing the kind of similar trends that Andre was talking about? Quite a benign view of regulation, then probably in terms of increased costs as well.
Well, maybe start off, since it's a demand morning, some broader trends before I get to some of the more detailed discussion. We see capital markets grow overall, especially in Europe, relative to banking and the way it provides finance to the real economy, and we see that as a positive trend, not only for our industry, but overall for the economy. We've just finalized a study that we commissioned to certain academics that I'm glad to be presenting to colleagues of Dr. Holle next week, which looks at the simple question of, does it matter for an economy what is the proportion of financing that goes from banking or from capital markets? And the answer is yes. And there are several channels that the study identifies. I won't go into that. But it is an interesting, we would hope, empirical study that shows that it makes sense for overall policy reasons to support capital markets, especially in Europe. Now, what that means from a policy perspective can be sometimes not so straightforward, because even, as Dougal said, with good intentions, we can get something which actually does not work that well. The securitization regulation that was passed, and I had the sad pleasure of participating in CRD2 negotiations when I was still in government, was a good example of where things can go overboard. This regulation was designed to actually increase confidence in the securitization market, bring back the securitization market. Didn't quite do that. Despite the sort of the very positive note that we see from policymakers around market finance and how we need to increase the share and obviously make it sustainable so it doesn't become a source of systemic risk, one needs to be still cautious, because with all the best intentions, sometimes we don't get good results. We can actually get negative results. Another good example is the support for venture capital funds that European Commission tried to get out in relation to their specific regulation that targets this sector. We've seen virtually zero take-up. Now we're discussing European long-term investment funds, and we are facing the same kinds of issues. So there's a recognition that we want more of this, but the way you want to regulate that whole sector and sort of give a boost to it doesn't necessarily lead to that desired outcome.
So it sounds like you're saying that it's a good idea to try and promote perhaps a different area, but then the actual regulation, when it comes down to it, doesn't always do that properly.
What comes to mind to me, coming from an ex-communist country, is that in Soviet Union, everybody wanted to have economic growth, and in all the ex-communist bloc, everybody agreed economic growth is a good thing. But everybody also agreed that there was one constraint: we cannot have private property as an institution that will be at the center of this. And so we'll try to find a way around it, and we'll actually set this one thing apart. But any sort of microeconomic textbook will tell you that that's a very easy way of bringing efficiency into an economy without having to mobilize the entire state apparatus. So it's all about recognizing what are the easy things, where can you let the market operate, as opposed to micromanage the way it does operate. And if you get that one issue right, if you don't have to rely on regulation entirely, and try to, especially in the professional sector, in the wholesale markets, be less intrusive, then potentially there's a way forward. But again, some sort of dearly held beliefs need to be potentially adjusted. And the shadow banking discussion is yet another, as in the belief that we need to move micro-prudential regulation to the asset management sector, for example, which in our view would be the exact opposite of what one should be doing.
Yeah, sure. Just I wanted to talk a bit
about. Just say whenever I hear other, so I have a little bit of an academic background, but I'm a third-rate academic. It's whenever I hear these academics writing reports for governments, as we chatted before,
earlier,
yes, I think it's a bloody disaster, because yes, these are guys who, there's some of these German professors who I wish there were some of them here, who just gather a bit of data, do some analysis, really terrible analysis. I wouldn't give them a job in my firm. Next thing I know is, because they're tenured professor, it ends on the desk of some bureaucrat.
Is it the quality of the research or the conclusions you don't like, or both?
No, I have no. Can I be quite clear about this? I have no issue whatsoever with conclusions which are factual, properly considered. Our business is so flexible. We will always find, if not us, others. There's always going to be an opportunity to invest. That's not going away. But what I find terrible is when you make policy on the back of terribly or ill-informed foundations, if you can even call them a foundation. And there's a lot of that about. And I think in some sense, because in Europe you really only have the UK in the Anglo-Saxon spirit, where finance, commerce is so well established.
I mean, you can see that with AIFMD, that specifically some of the really controversial aspects, like around compensation and risk management, the FCA has been trying to, I suppose, dilute the potentially negative effects of that in terms of adopting a more proportionality type rule, so that the smaller managers don't necessarily get clobbered with the same level of activity.
The FCA is brilliant, actually. I think it's a really good regulator, and I happen to even think that the SEC is quite good. They're pragmatic. They have little political agendas, but ultimately, they're good regulators. I don't mind being regulated. We're being regulated to the moon and back, and that's fine as long as it's reasonable. But some of the stuff that comes out of Europe is just not thought through. It's just not thought through.
Just for the record, I hope the study that you're referring to is not the Amos study that I talked about.
You not at all. You reminded me of some of the stuff that European politicians rely upon when they make policies, and some of the stuff is just laughable. you know.
We were having a brief
I mean,
discussion
just think
earlier.
of Dr. Holler, who's never had a financial job in his life. He worked at Boston Consulting Group. You know, I don't think he has the grasp to really get on top of some of the minutiae of financial markets, and I wish he was here, because I would say this to his face. You know, I don't think they have the. You need people who make policy who actually understand some of the minutiae of markets, and if you don't have that, it's a disaster.
Sure. I suppose the other counter argument might be that trying to have people who are then necessarily neutrally aligned, you know, after they leave their financial role to go into perhaps more of a government position, might be a challenge as well. I mean,
you had that in the UK, and you had Hector Sands who went to the FSA.
Sure. I mean, Hank Paulson as well, obviously in
Yes.
the US, but people knew that, you know, Goldman's wouldn't be allowed fold, or certainly
Yes.
that was whispered quite a lot as well. Just moving away from regulation now a little bit, there's obviously a debate within the industry around the synthetic financing versus securities lending, and you know what that will mean long term, if anything. And I was wondering, would you, Dougal, have any view on that?
Yeah, definitely. Look, I mean, I think it's a very, very small proportion of what goes out there, but I think it's something that's evolving. Our regulators, by the overall leverage caps that they set us, are very, very keen for us to deleverage in one form or another. And the way they do that is they set RWA targets, which then determines how much balance sheet effectively you have to offer out. And the synthetics, I think, have always been used by broker to broker in order to manage that balance sheet in one form or another. So I think those that manage to evolve that product will become incredibly useful to us banks, because it would be a way that we'll be able to continue to do our business in a more balance sheet efficient way. I think those that do it as well will, over a period of time, have an advantage, certainly a price advantage, if not just a capacity advantage, because I think we're all being driven towards that. European banks, I think, have adopted this a lot earlier. I think the US banks are just starting to think about it now, and I think it's going to become more of an issue overall for the business.
Okay. Andrew, would you have any view, or Yuri?
Yeah, I mean, sorry to bring regulation back into this, but I think the FMD is potentially going to be one of the drivers of moving towards synthetic, precisely because the whole relationship between the depository, prime broker, its custodians or sub-custodians, the fund, the administrator, and the manager is so complex that ultimately, and sometimes the liability provisions, especially if you invest in emerging markets, are such that it really becomes much easier for both the prime broker and the depository to manage the relationship between the manager and the fund. I mean, it's become a necessity in certain markets, and we've seen that before AIFMD, but I think AIFMD depository provisions are going to reinforce that. So, and it's an ironic thing in the sense that it is moving things. One of the issues that policymakers intended was that we're going to make the cash business safer, but people are moving away from cash. You know, whether you know to what extent that is a big trend, we're not gonna see until a few years down the road, because at the moment most European hedge fund managers will still be in a sort of using the offshore model, not forced to have the full depository as per Article 21. So we're not going to see big changes there, but to the extent that people are going to be one day or another forced between having an offshore and an onshore fund, that's where we may see the trend picking up.
And just on that, actually, I've been surprised that depository light type model that you're referring to there, where you've got your London-based, you know, maybe your Mayfair manager with a Cayman domicile hedge fund, that's probably received a lot less coverage even though it could potentially affect a very large number of funds. Certainly, any of the depositories that we've advised have actually been looking at basically moving their clients to a full depository service, even though they may only require Depot Light right now, because obviously the depository light under AIFMD is only going to exist for a couple of years potentially, and then depending on what happens with private placement, there could be a requirement for a full depository in the future. So it's interesting. Certainly
I think this whole using these synthetics, I think is a bit of a gimmick, and I think it's a gimmick because while it clearly works in the current framework, if the politicians and the regulators are bloody minded in Europe as they have been, I think this is, they will look through it. And I think, I'm not sure what's actually, are we just gaming the politicians? I don't understand that.
And Andre, I think you raise a good point there, because if you look at the FTT, the Italian FTT made sure that swaps were firmly included within that. The French didn't. So again, they do get wise to these processes, but I think it's a game of cat and mouse to a certain extent.
Yeah, and but that's the thing I would like to cut through, right?
No, I agree with you.
Yes, it's just bullshit. So set the rules, make sure you understand what you want, and I think I'm not sure who they're trying to serve in this process. I mean, the FTT is a great example. So you see volumes in Italy. I don't know what the Italians have achieved with the FTT. Now, as it happens, we trade a lot. Okay, so we buy and sell something like $1.5 billion every day, and we have our short book must be, I don't know, over $10 billion of positions at any point in time, and we have a similarly sized long book. And so the financial transactions tax for us has a material consequences. What it does actually just slows down the amount we trade, but interestingly enough, it doesn't stop you necessarily from making less money because the alpha, the opportunities are still there. In fact, in some instances, they're bigger. So who is the beneficiary in this? It's not clear to me what the purpose is of this. And that's leaving aside the fact that if you look at the way these things are intended to be taxed, I don't know the current state of play, but at one point it looked like every part of the transaction, the food chain, was taxed. So you'd be taxed like multiple times on what looks to you like a single transaction. So I don't know. To me, this is this cat and mouse game. I don't think this has legs.
Yeah, I think the problem is the minute you set those rules, then the regulators ask for more. So I think that's why you've always got to have this push and pull process. They're always asking for a lot more than possibly is achievable. So I think that's why that's always going to be the status quo.
And actually, when we were having a coffee this morning, we were talking about briefly the difference between the US regulatory approach to hedge funds and what's happened here in Europe over the last few years. How, Andre, does that affect your business at all, or how do you guys manage that? Do you have any US exposure?
Well, I love the fact there's a conflict between the Europeans and the US, and may that persist.
Regulatory arbitrage.
Yes. Secondly, I think, and I'm not sure everybody agrees with me. Look. It's not a question of whether I love the US or not, but I happen to think that the US, at the end of the day, is far more pragmatic than what comes out of Europe at large, not the UK, Europe. And so, however, in this Dodd-Frank bill is just a nightmare in theory, but actually, when you come to live it, it isn't so bad. Okay. And similarly, another thing about just as an example, we were talking about the AIFM. This whole European regulation, one of the most amusing things to me of all is we talk about knowing where the assets are and valuing them and all that. But think about it. Under the current regulation, the burden to make sure that the assets and the way you mark them and price them, i.e. the production of the NAV, is now I am personally liable for the value of my NAV. Okay? Whereas actually our agreements with our administrator, and this is very unusual, says that they are entirely and completely responsible for NAV.
But that's actually been superseded now by the regulation, essentially.
Yes.
Yeah,
Yes.
that's right.
And so, again, why does it's curious to me that a regulator should say, you know what, we will make the manager responsible for the NAV. Well, if you are a fraud, isn't that precisely what you want? Right?
AIFMD even makes the manager responsible for the depository getting access to the administrator's records. So really, the manager's head's on the block.
Saying that Madoff will be responsible for his own NAV.
Right.
That is the madness of what they're asking for.
And here you have a perfect example of some uninformed individual at the kernel of some policy driving this through, senselessly. That's all there is.
Any thoughts?
Having been involved heavily in the IFMD and as well as some of the Dodd-Frank negotiations, I think there are differences emerging between Europe and US. Some of them are driven by structural issues in the way that US regulators have much more flexibility and much more discretion that European regulators, notably ESMA, does not. So what happens in the European process, a lot of the decisions get politicized, and even if you delegate down to the regulatory procedure, you have to delegate a specific task. You don't just leave it open and say, just figure it out. You have to really spell out what you want the regulator to do and tie their hands. And we've seen that as being quite problematic in the sense that those who are closer to the markets with more expertise are then not allowed to use any flexibility afforded to them in legislation. And we've seen the CFTC and SEC use a lot of that discretion, a lot of that flexibility, be it extending deadlines, just simple things like that, or
with FATCA is a good example over the last few weeks. Obviously, that's been extended.
So that's one inherent issue that I see as slightly problematic between EU and US. The other issue is that US seems to have, by and large, moved on. So, for example, this discussion on shadow banking. There is some echoes there in the non-bank, non-insurance SIFIs debates, but it's not necessarily seen as very problematic because it is a capital markets-driven economy. So for them, shadow banking, it's a non-term for a lot of the policymakers, and it's something that they have to learn to understand, as opposed to here, it's immediately something that needs to be dealt with in an urgent manner. Because potentially we've got a massive risk growing without us realizing it. And so there's more stability there, less of an open-ended future for hedge funds as an industry in the US. Here in Europe, we're getting some closure with EIFMD finally being implemented. But again, the shadow banking discussions are not really making people that comfortable, especially in areas where there's a lot of capital trying to come to Europe and trying to finance the real economy. Hedge funds moving from the more liquid space to some of the less liquid strategies, especially in credit, and facing tremendous obstacles, both in terms of existing regulation and in terms of any future policy discussions. But in terms of the overall picture, I think what you've seen and what you continue to see is the confluence between the institutionalization of the industry, which has been really pushed by the investor, and the regulation. And those two things are closing and or putting to bed quite a few debates. There are a lot of hiccups and lots of difficult things that managers have to put their heads around, like the distribution of various responsibilities, where we thought the industry got the model right and put the made things fairly independent and fairly attractive for the investor, and now they have to sort of work around the regulatory obstacles. But the industry is actually finding ways of trying to get back to sort of independence of NAV calculation, for example, despite the regulatory push to do things the other way around. But overall, I would say there are some silver linings there in the regulatory interventions on the asset manager side. And in terms of the markets regs, things are becoming much more complex, and things are, in terms of the strategies that can be executed on short selling side, for example, people do see limitations. The disclosure thresholds are cause a real problem for a lot of investors who will not go as short as they could have. Some care much less about that.
I think this for us it's great. I love to see what other people are short.
Yeah.
Right.
Give you
So, and you can build a whole strategy out of that. But I agree with you. I don't mind if regulators want to get information, give it to them. May they drown in it. And do
you think people will get more comfortable with disclosure in the future? Because obviously with AIFMD, there's a ton more reporting that's just.
I just don't understand. In physics, there's a very, very basic principle which is called phase locking, right? Having all the information available at all times for all to see does not necessarily create stability. In fact, it can have exactly the opposite effect, in fact. And so, again, I don't know what the purpose is. I mean, why is a corporate really better off knowing who's short their stock? Maybe they don't take meetings from that fund manager. I don't know. But I think I just don't see the purpose.
Sure. So, guys, just with conscious of time, in a few minutes, what would be your view then in terms of going forward over the next year or 18 months or so, hedge funds and the security lending industry? What do you think will be the main trends or the key drivers? Maybe if we start up with Dougal, some final thoughts.
I think the biggest challenge we've got coming up in October will be T+2 and making sure that everything works its way through. So that's a challenge for the industry overall. The second piece that I worry about is the amount of liquid collateral that's out there. We've got the derivatives reform now, which is really firmly kicked off, the EMIR rules that firmly kicked off over here, which means now a lot of those transactions are going to go through the CCPs, which in turn now will need collateral. So not only do you have a smaller pot of usable collateral, and that's really determined by you, the lenders, in terms of what collateral they want to take against various different assets, but now you've got a bigger pull on that. So to me, that's going to be the big issue. And I think for hedge funds more generally, the issue they've got out there is best execution, because yet again, there's more focus on that, and there's a lot of focus on that, but again, very, very little clarification in terms of what they really want. So coming back to the point, it'd be miles easier if people actually laid out exactly what they want, and then we can learn how to work with it.
Sure, thank you. Andre, yourself? Any final thoughts?
Do you know, I'm always very negative about the world.
Well, we spent a lot of time talking about regulation.
So I have no idea, but I tell you, it's you know, God knows how many more iterations there will be. You know, you have another version of MiFID coming out, and
I've heard comments about AIFMD too, potentially further down the line. I don't know if you've heard that either, Yuri, but maybe
well, it's hardwired already in the legislation.
I mean, I think we've just seen the thinning of the wedge, frankly. Now, the question is, how is that going to change my life? Well, I don't know. I'd like to work another 20 years, hopefully, and if we make enough return. You know, I think, as I said, there's always a way, I think, to weasel your way through this all of this stuff. But it's just, you know, I think people should be honest about their objectives. And there's nothing I can do, or most of us can do, I think. And this lobbying, by the way, you know, I think it's necessary. I think it's necessary. But given some of, you know, the nature of some of this, I almost feel it's sometimes, if it's not done properly, it backfires in a big way. I think, right? Whereas the US is much more set up to deal with it. It's an acceptable thing, I think. And in the UK it is. And in fact, there's this whole other juxtaposition where, you know, the Germans just don't like the English, right? So. For example. You know, and so you have all these sort of twisted situations that are so deeply ingrained and embedded, nobody admits. But if you know, by the way, I have a German passport, so I can abuse the Germans all I want. Okay, I was born in Berlin. Okay, and I have some very senior people who are politicians, friends of mine who are politicians in Germany, and it's sad. It's actually sad. And you speak to any one of them, they sort of get it, but then there's this whole confluence of you know, it's very situational. You just it's directed in one way only, and they don't like the Anglo-Saxon way.
Yeah, sure. And Yuri, any final thoughts? Just we have a minute or so.
You know, I'd say that we do see the balance sheet pressure eventually translating itself to in the relationship between the manager and the prime broker. And potentially differentiation in the market in the prime brokerage space, as some PBs will potentially have, you know, the reduction or the attack on the dealership model and the ability for banks to hold securities, you know, is going to have repercussions one day or another. There will be differentiation between the managers as well in terms of what Dougal was talking about. Some of the larger managers who are now also moving into big long-only activities, becoming much more of a partner for the prime broker as opposed to anything else, as opposed to just, you know, taking service from them. And we see those discussions across the spectrum in terms of how you know, who is, you know, what kind of assets do you hold and how does that fit within your balance sheet overall. And there, the smaller manager is, and those who are in the less liquid space in the credit are starting to get a little bit concerned as to how, you know, how pricing is going to go forward, and whether, you know, in terms of all the regulatory and the reporting burden that's being put on them, whether they're going to be of value enough for the prime broker for them to take up some of the roles that regulation is introducing, especially as regards reporting. EMIR was a very good example. Securities financing transaction regulation is going to be yet another example where we've got two-way reporting, the manager equally responsible for reporting the transactions as the prime broker, but the prime broker not having to report or take up that reporting in any case. And so that's creating, you know, whoever has got some kind of a commercial standing with the sell-side communities is clearly in a different situation.
Great.
Can I ask quick question.
Yeah, sure.
Has anybody in this room ever had to fill out a report in terms of your short positions? Does anybody even know what it looks like? Or how, I mean, anybody?
Question for the audience.
So can you tell when we have a back office submitting our shorts to certain countries, it is almost as though they designed the web page to really piss you off. Okay?
It's difficult.
Yes, like do one stock at a time, and then log out, log back in, and do another stock. I'm exaggerating, but it feels like that. So it almost, and every country does it their own way, right? So again, you wonder, you sit there, you have to hire a person just to, and in our case, we have thousands of stocks we're short. I mean, it's a nightmare, just as a practical matter. And that sort of, is an example of just how thoughtless some of the stuff is.
Sure. Do we have time for a question or two?
Yeah, please. I'd love to hear some questions from the audience. It's been a very enlightening and honest, I think it's a phrase to say, debate. So any questions?
I'm going to pick on you. You.
So Andre, you're obviously, you've got some very strong opinions about the regulators. Is this a future career path for you? Where
absolutely not. I want to be on a beach flipping burgers.
You're not going to join AIMA anytime soon, or?
I don't think so.
Okay, great. Some guys, if anyone. Oh yeah, we have a question over here.
Yeah.
So I think this question is first to Yuri, but others may comment. So a couple of years ago, we were talking a lot at this conference about the short selling regulations and what they might mean. And I think it seems to me that the industries has found a way to get through it. And notwithstanding all the things Andre said, the issues, the industry has moved on. Do you think there's a benefit, however, in having a short selling regulation, even if we don't agree with what it does, in that it's taken the sort of regulatory focus away from the activity? Because, or is short selling something that's going to come back into focus again as soon as markets start misbehaving? So is there a benefit that's out there just by having a regulation that covers short selling because it's now considered to be a regulated activity?
No, of course there's benefit to regulation in general. As I said, the industry has benefited from just closing certain debates about, is it opaque, is it unregulated, is it non-transparent? No, that's gone, and people have adjusted. So it's traumatic, the entry into the very heavily regulated world, but by and large people are finding ways of coping with it and just getting back to business as usual. In terms of the short selling regulation, I mean that was specific, and there is an inherent distrust of short selling as such in certain countries, and to your point about the FCA, oftentimes they're not as enlightened as you would describe them, because the FCA was one of the leaders behind.
Mine was a relative statement. It was a relative statement, not an absolute statement. Okay.
So there was an intention from the regulators to quote unquote throw some grit in the wheels of the market, and a sort of a whiff of market abuse and kind of negative behavior associated with short selling. And I don't think that's necessarily gone away. So I think in relation to this one, because it institutionalizes bans on short sales, I would still think that there's this, we still have to see, because what happened, we had some hopes that the bans on short selling would become more difficult post the regulation. I don't think that's happened. We had hoped that the bans on short selling would become more harmonized post the regulation, so that people would understand what it means to impose a short selling ban on a particular set of instruments. I don't think that's happened yet. And we've been working very hard, and there's lots of resistance to not have short selling bans to be sort of triggered at a very, very low level, and B, to actually work to make the system more simplified, so that managers who need to comply can actually comply in time when they have to sort of change within 8 hours or so following the announcement. So I still think there's a long way to go on the short selling regulation.
I think it's a very good question, by the way, and I think I said this once at this event many years ago. If you go back, and I have the clippings, and you can get them yourself, from the New York Times in the 1930s, and if you were to Tipex out some of the corporates, some of the banks, and some of the dates, you would think this was a story written post-2008. There has been absolutely no difference. So the question is, and I think it's a good one actually, does the fact that there is regulation somehow permit it and make it more acceptable? I doubt it. I doubt it.
Okay, guys. I think we'll probably leave it there just to thank the panel. I think we're probably out of time, are we? Great. Guys, thanks very much for your time.
Thank you very much, guys.
Very much.